Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weade is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
Hey, I'm Casey Weade, and we believe in retirement strategies that are driven by meaning and purpose. Join us this week and every week as we discuss planning for your best retirement, pinpointing your purpose, building a rock-solid financial plan, and unpacking trending topics that could impact your financial future. Welcome to the show. Welcome to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me.
Hey.
And this is our opportunity to discuss retirement with you. So if you're at retirement, in retirement, near retirement, or you're just seeking that coveted job optional status, you have found yourself a home, we're going to have a wide-ranging discussion today talking about everything finance, retirement, markets. We're going to hit on inflation. Should you be concerned? What can you do about it? We're going to be discussing when to de-risk your portfolio, cryptocurrency, marital compression in retirement, and how to manage it. Not to mention, we're also going to have some amazing guests and experts discussing real estate and relocation in retirement. But off the top, we're going to be covering an article from our weekend reading for retirees email series. What is that? Well, you'd know if you went over to retirewithpurpose.com and signed on up. There, you can sign up with first name and email, and then you will, from there on out, receive one email every single Friday with 4 articles on trending topics in the retirement planning space, trending topics in the financial planning space, all designed to keep you on top of those latest trends so that you can make better decisions with your hard-earned dollars. Again, sign up at retirewithpurpose.com. We also do a full-length discussion around a couple of these topics every single Friday on the podcast. You can also check that out on the website. This week, we're going to be spotlighting an article from Reuters titled "A Chill Fed, Cool Inflation, and a Long List of Reasons Not to Worry." So far. Yeah, great title there. Howard Schneider has got an article here that covers inflation. And listen, there's probably no other topic out there right now that's creating as much buzz in market talk as well as political talk. Oh, yeah. We're hearing a lot of concerns around inflation between the trillions of dollars coming off hot from those printing presses.
Coming in hot.
In the news headlines lately, there are some concerns around inflation, and those concerns should be addressed by your financial advisor. And here's the thing. The Federal Reserve, they've laid out a long list of reasons that they don't fear the recent price jump in the price of many goods, and they don't fear that really spiraling into a larger problem. And most of their arguments rely on balancing dynamics of supply and demand, in addition to a little public psychology and some faith that the same forces that have kept inflation tame since the 1990s, the last 3 decades, be it international trade or internet-driven price competition, this will continue to happen after the pandemic is long gone.
Yeah. Boy, I like that phrase there. What was it? A dash of public psychology. Wow. If that isn't a political term, I don't know what is.
Yeah, that's right. And I think there's always a counter argument, obviously, to any argument.
Sure.
And here, if things happen differently, that's the real risk. If things happen differently, that we emerge from the pandemic or emerge from a recession differently than we have before, then that might force the Fed away from some of its current efforts to encourage maximum job growth, right? That is the main push of the Fed today, to encourage maximum job growth, balancing their 2 main priorities. And then that would force them back into this old role of hiking interest rates, much like you saw back in the 70s or 80s, until prices ease, usually because people start getting fired from their jobs as the economy slows. And their purchasing power, a key driver in inflation, if that were to happen, that diminishes.
Yeah, and we want that Goldilocks sort of situation. It's not too hot, it's not too cold. Inflation's not too hot, it's not too cold. But that's a difficult thing to do, Casey. And with these policies that we're seeing right now, the Fed is comfortable that they can have their cake and eat it too, with a strong economy, continued job growth, and inflation that behaves itself.
You know, I see this as an unbiased article. Maybe you view this as an unbiased article, maybe you don't. I included this in weekend reading because most of the articles that I see out there, they're very fear-driven. They're very headline-driven. They want you to think that doomsday is right around the corner. That is the goal of every major news media outlet, Porter Stansberry to be one of the many. Yeah, these media outlets are there to sell you newsletters. They're there to sign you up for different email signups. They want to get your subscription dollars. They want you to sign up for the New York Times, right? That is the goal of a major news media outlet. Yeah. And the reason I like this particular article is it was truly fact-based. And I think it's sharing a lot of factual information that you're not seeing in a lot of these headline articles.
Well, and I think that's just it. People hear about the Fed and the trillions of dollars here, and they immediately think, well, runaway inflation.
Yeah. Well, that's the same thing that individuals thought back during the financial crisis. Following the financial crisis, it wasn't a whole lot different than what we're seeing today. We had a lot of money coming off hot from that printing press, and there were a lot of fears around inflation at that point in time, and they didn't come to fruition. And a lot of individuals made horrible mistakes around that period of time. I was actually just talking to one of our financial advisors earlier this week, and he was sharing with me an encounter he had with one of his clients who wanted to introduce him to another potential client, a friend of his.
Sure.
And he said this friend has been all in on oil because back about 10, 12 years ago, his financial advisor said, hey, oil prices are diminished. We're going to see rampant inflation in the future. Look at the money coming off the printing presses, and went heavily with the majority of their assets into inflationary index assets, largely oil, that just simply didn't perform, didn't recover over that period of time. And now it's led to somebody that's a very frustrated client. I think the financial advisor you're working with, they should be there to bring common sense to the table, maintain diversification, and follow a planning process. And I want to come back to that because I think that's really where we need to be right now. That's what you need in your life right now, is we need some foundational talk.
Yeah, whether it's inflation or some other challenge, if you've got a good plan that's allocated to guard against all these various risks, then you don't have to lose sleep over things like inflation.
But it's easy to get distracted by the one risk that's hitting the headlines, and that was inflation here recently, because we just saw the biggest annualized jump in over a decade in inflation at 4.2%.
Right.
Let me say that again. In over a decade, okay? So that's not all that long ago that we've seen inflation at these levels. It's not that crazy to see a 4.2% annualized inflation jump.
And as this article points out, you have to take into account that this is a year-over-year reading. Well, what was happening a year ago, right? Prices were falling rapidly at the start of the pandemic. Yeah. Stores were closed. Things were shutting down. Prices went down. So the fact that we look at the data here in this article, and it shows, even if we would have just maintained a steady level of inflation, that would be a lot higher than where we were a year ago. So it's right to assume that there's going to be this fallback on the future calculations.
Yeah, and we should return to a normalized annual inflation rate, and that's what we're seeing. We're seeing a slow return to normal. We're seeing a return to normal, and a return to normal would be a big 12-month increase because we had a very abnormal period of time about a year ago. And then the article's also pointing to the trillions of dollars that have been rolled out to fight the pandemic. And what's that do? Well, when we have all these dollars that are being planted directly in your pocket, this is propping up consumer spending. And if we see prop up in consumer spending, we're going to see a boost in prices all at the same time. But that boost is expected to fade, and any related price pressures with it, because we saw the push out. There aren't more trillions of dollars being stuffed into Americans' pockets in the coming months. Potentially there could be, and that could change everything. And that's exactly what the title of the article is saying, right? So far, at this point, there isn't any reason to panic around inflation regarding where we stand today. Something has to change in the future for that to become a reality.
Next up, they talk about the surging commodities. I think lumber is the one that most people are familiar with. But consumer spending arises from fiscal support that surprised manufacturers who scrambled for raw materials, stretching supplies and pushing prices up.
Yeah, there was a lot of demand during the pandemic. I mean, it was wild, right? Economists didn't expect this. Manufacturers didn't expect that all of a sudden we'd have all these people rushing back to their house going, you know what? That kitchen needs remodeled. You know, I hate my back porch. You know, I'd really like to have a pool, right? There was this huge spike from housing to appliances, and input prices surged, as they should. When demand spikes like that, we're going to see prices follow along with it. But I think what's not covered in this article and what's not discussed nearly as much is what happened during that period of time. Manufacturers had to shut down, some for months, where they no longer were producing those inputs. Then they're back up and running, and they can't get delivery drivers. So we have a shortage of delivery drivers. We have a shortage of products. That's obviously going to increase prices.
Right.
And again, these are things that will tend to normalize in the coming months, coming year.
Yeah, they also talk about the labor slack here, Casey. Currently, about 4.5 million people between the ages of 25 and 54 are out of work.
Yeah.
Since before going back, you look back before the pandemic, that wasn't a problem.
Yeah. And if we have this happen where we have so many individuals that are unemployed, we would expect that we would see some price moderation around that. But I think there's also two different things going on right here. We've got these individuals that are out of work, but we also have unemployment benefits that are propping up inflationary prices right now. Now, when those unemployment benefits end, what happens? Those people get back into the workforce, and we see some type of normalization as that slack is picked up. In either case, it will end at some point in the future. And I think the last point is one of the most interesting ones. What's imagined is real. The Fed, they're not all that concerned about a breakout bout of inflation because they have had success in keeping price increases moderate for 30 years, 3 decades. And that means families, businesses, major investors, we all now kind of expect inflation to stay the same. And those well-anchored expectations, those are a potent weapon for the Fed to wield. And then we've got just the motivation of the Fed. The motivation of the Fed is to control inflation, because if we go back to the 70s and 80s, the Fed used high interest rates in the 70s and 80s to contain inflation. And what happens when they do that? Then we see a price paid through high unemployment. And so the Fed knows this is a real risk. They want to control inflation. They want to control interest rates. They want to keep things moderate. And this isn't to say that this won't change. This isn't to say that inflation shouldn't be a concern of yours at all. As we always say about any risk in retirement, it should be addressed, but it should be addressed as part of a planning process. When you sit down with our team, we're going to address inflation, but we're going to do so inside of a larger planning process to make sure all of your bases are covered and we don't get tunnel vision, because that's what you need in order to have a secure and independent retirement. And that's why we're offering you a complimentary financial review right now for the next 10 callers, where you can meet with an independent financial advisor on our team, either in person or through a video meeting from the comfort of your home, and we'll help you determine how prepared you are to handle retirement pitfalls like inflation, healthcare emergencies too, stock market crashes, rising taxes, all risks that you need a plan for as you step into retirement. And we will deliver to you a written financial plan at no cost. Give us a call right now for the next 10 callers, or just text CONSULT to 866-482-9559. That's 866-482-9559. Text CONSULT or give us a call for a comprehensive financial review at no obligation. Stick around, because up next, we have questions from you.
First-time callers are eligible to receive 1 in-stock book per request. Limit 1 book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. It's your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me. This is our opportunity to answer questions from you. So if you have questions, we have answers. Just head on over to retirewithpurpose.com. In the bottom right-hand corner of the screen, there's a little text box. You can text your message to us right there. You can also shoot us a text at 866-482-9559, 866-482-9559. Or if you're a email user, they don't even call that snail mail. It's kind of turned into snail mail. But if you're an email user, email us at info@howardbailey.com your question, and we will get an answer back to you. And if you'd like to have your question featured on the show, we will do that, just like we have here for Randy. And Randy says this. Randy says, I'm 57 and plan on retiring at age 65. I'm still in accumulation mode, but at what point do I gradually begin taking my foot off the pedal and become less aggressive in my portfolio in preparation for the distribution phase?
Hey, great question, Randy. Hey, to each their own. Some folks begin doing it 10 years out, 5 years out, 7 years out. It really is case by case dependent, but at least you're thinking about it. At least you recognize that the accumulation phase ends at some point, and then you start a distribution phase. So it can be a phased process, pardon the pun, there, where you start to reallocate assets to more stable value funds or something along those lines in your 401k, in the expectation of, hey, I'm going to need to start to draw on this in the next 5 years. You're in that, what do they call it, Casey? The red zone?
The red zone, the retirement red zone. And I think first I want to offer somewhat of a general answer, and that is more around retirement planning. When should you start implementing a retirement plan? And then we can drill down into your specific situation on how much risk you should actually be taking at this point in your life. The retirement red zone, as has been described by one of our favorite finance researchers and coaches to financial advisors, Michael Kitzes, and we shared this article in a previous weekend reading article, as well as discussed it on the Retire with Purpose podcast. The retirement red zone is 10 years before your retirement date and 15 years after your retirement date. Those first 10 years, that's what's known as retirement date risk. And the next 15 years, that's what's known as sequence of returns risk. And think about it this way, Randy, you're 57, you want to retire at 65. What if today is 1999? And if today is 1999 and you're 8 years out from retirement, then that means your retirement date would be around 2007. And if we looked at that time frame from 1999 through 2007, you would have been really happy that you de-risked your portfolio. Because what if your $1 million today is worth $900,000 when you retire? And that's the reality. That's something that's a real possibility. Individuals that say, well, the market never goes down over extended periods of time. Well, it's defined extended period of time. Extended period of time, if it's 10 or 12 years, there have been periods of time in the market where we've seen recently a 10, 12-year period of time called the lost decade, where there were no returns in the equity market over that period of time. We saw this after the Great Depression, which maybe that never happens again, but there were 25 years where it took the market to recover. It took the market to recover 25 years. Do you have that kind of time? You might find, Randy, that at 57, you need some returns, and maybe you only need to make 3, 4, 5%. Maybe you don't need to make the 7 to 10% that you've been hitting, for the fences for, and you can dial things back and at least set a foundation that says, okay, at least I know now I'll have enough to step into retirement, and then maybe you can still take risk with those dollars that are going to be needed further down the road in your retirement.
Great question, Randy. Next up, we've got Anita, and Anita says, what are your thoughts on cryptocurrency? Is it worth the hype?
I'd say anytime you've got billionaires being made off of minimal investments, anytime you've got a 12-year-old that invests $1,000 and becomes a multimillionaire in the matter of a few years, that sounds worth the hype to me. That's fun to talk about. That's an interesting thing for us to explore and discuss and do research and read articles around it. It's something that makes a lot of headlines because it's really interesting. Cryptocurrency is very complex, and it's really interesting to see how currency is potentially evolving. Is cryptocurrency going to be a fad? Is it going to be something that's still going to be here in 10 years, 50 years? I don't know the answer to that. It could be a short-term fad, or it could be the next global currency solution.
Sure.
We just don't know the answer to that. But I think, yes, it's worth the hype. And the way that I would view cryptocurrency as a function of your overall portfolio is, again, defending against some of those outlying risks. I think of it much like a doomsday scenario, being that it is so high risk, being that we don't know what the future is, being that you could put your life savings in there and it could go to zero at some point in the future. The uncertainty does not make it a viable foundational retirement solution.
Core.
And again, this is how we go back to our process. Our planning process starts with setting that foundation, setting aside funds for emergencies, setting aside funds to know you have a stable income the rest of your life, setting aside funds for flexibility, inflation protection, setting aside funds to protect against healthcare. And then if we have some funds left over, then we have the ability to start playing around in these different areas to defend against things like currency devaluation or a change in the way currency is utilized in the global economy. And I am an owner of crypto, but not to an extent that it would hurt me, to an extent that I get an education about how cryptocurrencies work. I have a little fun doing it. And if it goes to zero, it's not going to change my financial life. That is how I view cryptocurrency. So yes, worth the hype. Worthy of your investment? Well, that's a different question.
Yeah, absolutely. And I think, too,
Can I add? I said investment. Now, let's be careful. Is crypto an investment?
Well, Warren
it wasn't
Buffett,
designed to be an investment.
Warren Buffett would say no. He says cryptocurrency doesn't reproduce. They can't mail you a check. It can't do anything. And what your hope is that somebody else is going to come along and pay you more for it someday down the road.
It doesn't meet the definition of an investment.
Right. But I think, did you hear the story about the guy who's locked out of his wallet or thumb drive, where he's got $220 million worth of Bitcoin or some digital currency, but he can't get into the thing. So that poses quite the risk, right? I'm terrible with passwords. This would probably be really bad for a lot of wealth for me, because I'd never be able to get back into the darn thing. And not to mention all the estate planning problems with making sure your beneficiaries have your code or your keys or whatever it is. But yeah, I think it's worth the hype. The blockchain technology is amazing. That's going to revolutionize lots of industries, but it depends on the person. Let's put it that way.
Our next question is from Lorraine. Lorraine says, I'm currently retired. My husband will be retiring within the next month. I'm worrying about how this transition's going to go, and we're going to be spending a lot more time with each other, and I've already created a routine I enjoy. What are some ways to help make this change go smoothly?
Ooh, it's such a good question. Casey, this is a unique thing that we get to see firsthand experience with when people stepping into retirement, and we call it marriage compression. You've had lots of guests on your podcast talking about this very topic. Yeah. There's a great book out there called Honey, I'm Home that deals with this as well.
Yeah, and we actually have some copies of Honey, I'm Home. That is exactly what this book is all about. You go, hey, I've got my life over here. I've been retired for a few years. Now you're going to come home and be disrupting everything that I've worked so hard to create here, my little life.
So one, recognizing it, right? She's at least recognizing these potential challenges. Two, communicating, having direct communication and talking through this with your significant other is how you start that process and make sure everybody understands, what are we trying to create in retirement? What does our life look like? What do we want it to look like?
Yeah, check out the Retire with Purpose podcast. Episode 204 is the most recent with Ellie Martinez, a marriage and wealth blogger as well as consultant. If you'd like a copy of Honey, I'm Home, just give us a call right now. If you're listening and you're dealing with this issue, we'd love to get you a copy of Honey, I'm Home to manage this and mitigate the risks. So call us at 866-482-9559, 866-482-9559 right now. We'll send you out a copy of Honey, I'm Home. Some of my favorite ideas have to do with different, activities and discussions you can have together. I think the common theme throughout all of these different books and individuals that I've interviewed has been around values and setting expectations. It comes back to communication, setting your expectations for your schedule, setting the values for your life, the time that you need alone, the time that you want to go out and do different things. You need to know, hey, this is my schedule. This is my schedule. Do we have any conflicts? And can we work through this together? Another thing that I would recommend is picking up a copy of my book, Job Optional, which I want to offer to everyone right now. I've got a Wall Street Journal best-selling book, Job Optional, and it's all about helping you understand where you stand today, preparing your values, preparing your purpose for retirement, understanding what retirement's going to look like, creating that vision for retirement, and then walking you through a comprehensive planning process to make sure you systematically address each and every one of your risks. What I find that most people say they loved about Job Optional are the stories. In there, I tell you story after story about retirees who have done it right, that have done it wrong. You get to learn from their mistakes. You get to learn from what they've done right. You get to learn from their mistakes. You get to learn from their successes. And give us a call right now. We'll send you out a free copy of Job Optional. Just give us a call right now at 866-482-9559. We'll put a copy of Job Optional in your hands. That's 866-482-9559. Stick around, because next up, we're going to be hitting on real estate. We're going to be hitting on relocation and retirement. And we have some really special gives as well. So we'll catch you after the short break.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome back to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me. And this is our opportunity to invite some very special guests on the show, share with you some highlights from the Retire with Purpose podcast. What's a podcast? Well, if you don't know, check it out at retirewithpurpose.com. Just click on the podcast tab. You'll be able to listen to the hundreds of episodes that we have out there and all of the world-class guests that we put in front of you to make sure you're up to date on the latest trends. Today, we're going to be highlighting real estate and relocation experts. And we featured several guest experts on the Retire with Purpose podcast who have discussed everything from utilizing real estate as a retirement income strategy to optimizing your own living arrangement and lifestyle. And we're going to be sharing that knowledge with you today. We'll also be including a giveaway to go along with these discussions and guests. So if you find the information shared insightful, don't only check out the podcast episode, but stick around to find out how to get yourself a free guide. You can also check out all of these episodes at retirewithpurpose.com. So let's get started with our first guest. Episode number 182, we featured Jason Hartman. Jason is a two-time guest. He is a real estate investing expert, CEO of Platinum Properties, Hartman Media Company, as well as the host of the Creating Wealth podcast. Since purchasing his first rental property when he was just 19, Jason has been involved in thousands of transactions across the country. He joined us on the podcast for an in-depth discussion on the role real estate can play in your retirement strategy, the difference between real estate and property that reliably generates income, and how to use it as a highly efficient part of your retirement portfolio. Right here, we're going to be spotlighting a segment where he shares with us the pros and cons of renting versus owning a property in retirement.
And when you're a homeowner, it actually restricts you. It bogs you down. It weighs you down. It limits your flexibility. Whereas if you're a renter, you can just give notice to your landlord and you can move to where there's a better opportunity. And America is a very mobile population. So, there's nothing wrong with renting. I think it's a great thing. Now, what I really recommend for people watching and listening are, most of your viewers and listeners are probably homeowners, and that's fine. There's certainly some psychological benefit to being a homeowner. I'm a homeowner. I've mostly been a homeowner throughout my life, but sometimes I've been a renter. And renting a high-end property for yourself and owning a lot of low-end properties that you rent to other people is a fantastic deal. That is the best double arbitrage ever.
Yeah, Jason threw out some crazy ideas, or you might think these are crazy ideas, but I have friends that do this very thing.
Mm-hmm.
This is an arbitrage opportunity, right? They're getting 10, 20% total return on these rental properties versus if you had a high-end home and you were trying to rent that out, you might be getting 5, 7%, maybe as high as 10%. You're going to get a lower yield on a high-end property than you are going to get on a low-end property. And I have friends that have mortgaged their home or just sold their home altogether, and they're renting, and then they're using that capital rather than placing it in this home that's really just an expense. They're taking those dollars and investing them. They're using bigger returns on that cash to rent someplace rather than own it. And we've got a lot of retirees that are often asking this question: should I rent? Should I own? Well, in retirement, hey, you have this money for a reason. A home isn't the best investment. It's not what it was back in the 90s. It is an expense. It is typically a liability, really, at the end of the day. And it can make more sense to eliminate that headache and just simply rent in retirement. I don't have a problem with it. But again, I'd encourage you to check out episode number 182 to know more when we discuss this in full length on the Retire with Purpose podcast with Jason Hartman. Next up, we're going to be spotlighting Keith and Tina Paul. This is episode 97 of the Retire with Purpose podcast. This couple in their mid-50s, they decided to leave Southern California to shoot on down to Ecuador to make that their home. Before retirement, Keith and Tina, they were very successful business owners and healthcare practitioners. They've got a hugely popular blog. They've actually been on HGTV's House Hunters International. You might have caught them there. And they love the comforts of their former home, but they love even more the cost of retiring abroad. And that allowed them to retire early by jetting out of California and shooting on down to Ecuador. We're seeing more retirees do this every single year. This is Keith and Tina Paul sharing their biggest and most unexpected benefit from moving abroad down to Ecuador.
Well, healthcare is a big deal, right? I think that one of the hardest things for an American to retire early in the U.S. is healthcare. It's so expensive. I think you're going to pay over $1,000 a person to have healthcare if you're younger and not able to get Medicare yet. But here, healthcare is great. Many of the doctors here train in the United States
or in Europe. And if you can have insurance, but if you don't have insurance, you can pay out of pocket, and you could be in the hospital for 3-4 weeks and it would not be catastrophic like it would be in the U.S.
Yeah. Ecuador has a government health insurance policy that you can get for $73 a month, and it covers pre-existing conditions.
Yeah.
Okay.
If you don't have any pre-existing conditions, you can go with the private health care, maybe for like about $120 a month. So it's so much cheaper than the U.S. Right now, if we wanted to go to a doctor, it's about $25, $30 for a doctor visit.
Now, if you're concerned about healthcare costs, maybe that's keeping you from stepping into retirement. Well, maybe you just want to move on down to Ecuador. We've got a lot of clients that are doing international travel to find lower cost healthcare solutions. Dental is a big part of that because your Medicare won't cover your dental when you're in retirement. My dad has went down to Mexico for dental procedures. My mom has done the same thing. They've done all of this to reduce those healthcare costs. So this is a real thing, and this might be a real opportunity if you enjoy traveling abroad. You might just want to check out episode number 97 of the Retire with Purpose podcast, where we interviewed Keith and Tina Paul. Next up, we're going to be sharing a clip from John and Ingrid Sullivan's interview. This is episode number 109 of the Retire with Purpose podcast. John and Ingrid, they are the owners, the founders of a company known as Senior Downsizing Experts, where they help boomers, seniors, children of aging parents with moves that can be very challenging and emotional. Relocation and retirement, downsizing. They joined the podcast to discuss the financial and emotional benefits of downsizing, some of the unique challenges that you're going to face, and how to craft what I thought was really interesting was a downsizing plan. Maybe you have a financial plan, but have you incorporated a downsizing plan to help make your next years be the best and simplest and most efficient as they can be? So what is a downsizing plan? Well, let's hear it from John and Ingrid Sullivan.
Well, the downsizing plan is having a consultation with a professional that is going to be assisting you in that. Talking about the long term, what type of living what is your goal? Where are you wanting to go? Are you wanting to move to a house? Are you wanting to move to a retirement community? Getting floor plans so we can talk about how much stuff are you going to be able to take? Having our packer come in and do a walkthrough with you on your home to help you figure out what's going to go with you and what's not. Then marking the things that are going to go with you and those things that are going to be left behind for the estate liquidator when they come to do their walkthrough with you. And then when are we going to put the house on the market? Are you going to move first? Are we going to sell it and then you'll live in it and then we'll move afterwards?
John and Ingrid Sullivan have a really helpful workbook that I enjoyed and have shared with many of the families we work with that are thinking about relocating. If you're thinking about relocating in retirement, pick up this guide. We'll send it out to you for absolutely free. Ingrid, John, they sent it over to us. It is titled The Ultimate Guide to Downsizing. Downsize your life to upsize your lifestyle. If you'd like to get a copy of The Ultimate Guide to Downsizing, give us a call right now, 866-482-9559. Next up in our last feature is Dr. Sarah Gerber, a certified retirement coach and psychologist. This is episode number 91 of the Retire with Purpose podcast, where Sarah covered a wide variety of different topics with us as an element of covering her book, Essential Retirement Planning for Solo Agers. One of those areas was relocation, and she shared how she helps people decide where they should retire and whether or not to relocate.
By looking at their own goals and their own values. If they value being around family more than anything and they have lots of family, then it's probably a good consideration is to think about moving to where most of your family is or staying put if your family is already living near you. So there are people who value climate over everything, want to be sure that they're living in a climate that where they never have to shovel snow again. I hear that a lot. So, there are a whole bunch of states that would qualify as somewhere to live if you didn't want to shovel snow. And it's important then to go out and do some reconnaissance. Take a look, scout around, see what appeals to you, see what the prices are, see what you can afford, what the environment is like.
Sarah covered a lot of the softer elements of relocating and retirement and so much more in her book, Essential Retirement Planning for Solo Agers. We talk about the financial aspects of relocating, taxes, etc. And we have a special offer for you. We've partnered up with Dr. Sarah Gerber to offer free copies of her book, Essential Retirement Planning for Solo Agers, a retirement and aging roadmap for single and childless adults, to you right here today. The guide is all about helping solo agers make the most out of their second act, how to age well, and ways to secure a confident future. To claim your free copy of Essential Retirement Planning for Solo Agers, call or text the word SOLO, SOLO, to 866-482-9559. Again, you can claim your free book by calling or texting the word SOLO, SOLO, to 866-482-9559. That's 866-482-9559. Stick around, because after this short break, we're going to be covering the dimensions of wealth.
First-time callers are eligible to receive one in-stock book per request. Limit one book per week per household, up to 3 books per calendar year. See full terms at howardbailey.com/terms. You're listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. This is Retire with Purpose, hosted by Casey Weade and Marshall Johnson.
Welcome to Retire with Purpose, the science of retiring with confidence, the art of living with purpose. This is your host, Casey Weade. Joining me, my good friend and co-host, Marshall Johnson, here with me to cover another weekend reading article with you. Weekend reading. That is one email that goes out to you every single Friday, all designed to keep you on top of the latest trends as we share 4 articles on trending topics in the retirement planning space, the financial planning space, all designed to help you make better decisions because you're on top of the latest and the greatest. We offer a quick summary along with my takeaways, and then we also like to take one of these articles and spotlight it on the Retire with Purpose podcast in full length, which we did with this very article. This one's from Kiplinger. It is titled The Dimensions of Wealth, Influencing Your Financial Path. If you'd like to hear the full-length discussion as well as getting a link to this article, check it out at retirewithpurpose.com. Just click on the podcast tab and it'll be right there.
Boy, the author here, Dawn Dobler's got lots of letters after her name there, Casey. She's got some pretty good designations, and she's got a really good article here.
Yeah, she's got a lot. MBA, CPA, CFP, CDFA. So, I got a little excited when I saw the article because you've got someone that knows what they're talking about.
Right.
And, that's not always the case when you pick up articles online. And this was one that I thought was really laid out well to help you better understand how you should be thinking about financial planning as your financial life evolves, as you continue through your financial years, one year after the next, things are going to evolve, and you need to have a unique plan to address each stage of your financial life. It's kind of like a kaleidoscope, right? You look through that kaleidoscope, and what happens? You see this one-of-a-kind mosaic, and then you twist it, right? The circumstances change a little bit, and you've got another one-of-a-kind mosaic. It's called personal financial planning for a reason, because your financial plan should be personal. It should be one of a kind.
Yeah, she paints a really good visual there, talking about, your unique set of pieces and patterns. And with each slight turn or shift, a new pattern will emerge. And I think that's great because we've often said, hey, these rules of thumb, while they might be great as a starting point, you cannot use them to build a really customized financial plan.
So why then did you just accept advice from your friends? Why did you just accept advice from your neighbor? Why did you accept advice
my
from
neighbor
your
just
family
made
member?
40% on crypto. I got to have some crypto, right?
We can't rely on advice that doesn't apply to your unique financial situation. We can't rely along those lines. We can't rely on financial advice that was simply created for the masses. You can't rely on some simple retirement calculator online that says, hey, you're on track. Your unique circumstances are not the same as everyone else, on your Rolodex. And did I say Rolodex? Everyone else on your Rolodex.
Do we still have those?
I still have a Rolodex. I don't know why I still have it, but they do exist, and
they're out there.
For all of those hundreds of individuals that are still in my Rolodex.
Those 25 people.
I can tell you what, my financial circumstances are dramatically different than those other individuals, and I have to create a financial plan that's crafted a little differently than they do. And that's because my circumstances are different. And
yes.
The author breaks those circumstances that are going to affect the way that you plan down into 4 different dimensions. There's 4 dimensions. You have personal dimensions, you have wealth dimensions, family dimensions, and money experience dimensions. And some of these are fairly static. Some of them are more dynamic, and it's important to recognize the two.
Yeah, she lays it out here wonderfully. When we talk about those personal dimensions, these things are pretty straightforward, right? You go at age, marital status, your personal health, your level of education, short-term goals, hobbies, activities, charitable causes, values. Anybody that's kind of doing retirement planning is going to kind of ask those things, right? Very basic.
Yeah, you've got those personal dimensions. You've got those static areas. Let's say your age, as you said, the age or marital status. They don't, sure, they're going to evolve a little bit, but they're not going to be all as impactful as you're going to find with your personal values, your dreams, your charitable interests. Those things tend to be a little bit more fluid and prone to evolve as you're going to move throughout your life. And so those things do need to routinely re-examined. And I think, even for myself, if I didn't have Marshall here to sit down with a couple times a year and say, hey, this is what I'm thinking, I might completely forget some areas of my financial life that have changed and I need to adapt or I need to make some changes. I know that's been really helpful for myself. I have a gentleman that comes to mind as well, and this seems to happen quite a bit. We started working together about a half a decade ago, and we started working together, and this guy just wanted to retire. He wanted to generate $100,000 in annual income on top of the Social Security, on top of his pension. We're 5 years later now. He hasn't spent any of that $100,000 annual income that he wanted to create. And so did we create that income? We set it up so we could turn it on, but he never turned it on. So his understanding of what type of lifestyle he was going to have in retirement, it has evolved over the last few years. And every single quarter over the last several years, we would sit down and talk about the evolution of that plan, the changes that needed to be made. And one of those changes had to do with charity. One of those changes had to do with legacy. Most of the time when we sit down, we start working with you, we're going to find that you're not ready to make charitable decisions. We need to put together a plan today that's going to get you into retirement, that's going to create that sustainable income you can't outlive. And then at some point in the future, you might be open to that conversation about charity, about legacy. Sure. But if you don't have that person that's continually sitting down with you and having these types of conversations about what has changed and what we need to be thinking about, then you can easily overlook these areas that do need to be routinely re-examined.
Next up, she dives into wealth dimensions, overall level of wealth, composition, complexity of assets, any debt, tax situation, short-term spending needs, sources of income. She goes on to say that income, saving, spending, investing, debt, and taxes are all interconnected. Overlooking even one of these areas can be costly.
Yeah, I think that's one of the things that's really stands out to me in this particular dimension of your financial life. And what makes it unique is that your tax situation is going to be a lot different than the next person. Sure. These things do evolve over time. And it's important for us to remember it's not about the gross. It's about the net. What are you getting at the end of the day? It's not about the gross return. It's about the net return. It's not about your gross income. It's about your net income. And all of these things are going to be intertwined, especially as you step into retirement. You may have dividend income, you may have ordinary income, you may have long-term capital gains, and all of these different areas, not only can they affect each other from these income, savings, spending, investing dollars, but they can also impact your Medicare costs. They can impact your Social Security. And that composition is going to change over time. Yes. Just like legislation, when it comes to tax legislation, is going to evolve over time. You need someone that's going to keep you on top of those changes in your income composition and help you deploy different strategies when the need arises. And if you're not getting that today, if you'd like to sit down and discuss what the tax situation is today, how your income composition has evolved, and how we should be making changes to adapt to current legislative changes that are on the table, give us a call right now. We'll do a free tax analysis with you. 866-482-9559, 866-482-9559. Next up, Marshall.
Family dimensions. So we've talked about personal dimensions, wealth dimensions. She now digs into family dimensions. And Casey, I guess this is where I see it firsthand, where things start to get a little bit more dynamic, right? You've got your relationships, you've got your length of the relationship, the dynamics of your relationship. Oftentimes we sit down with families and say, well, she's conservative, I'm aggressive. You got these different interplays in your relationships and in your family that can even impact health as well.
Yeah, to me, I see this most importantly, I see this in the area of estate planning and legacy planning. And this is something that I see a lot of do-it-yourselfers overlook. I see a lot of individuals that are following the neighbor's advice overlook, is going back and revisiting those beneficiary designations, your will, updating those trust documents, updating those things on a regular basis, because life happens. Things happen in family where you want to change your beneficiaries, or maybe you forgot to put beneficiaries on your accounts altogether. Maybe there's some legislative changes that have come out and now you need to make some adjustments to your estate plan. I've seen this with special needs families. We had a couple that came in. They had been advised by one of their previous advisors to put away dollars for their special needs daughter, and they were setting aside funds in their special needs daughter's account in her name, and all of their accounts were designated to go to her upon their death. However, she depended, even if they were to pass away tomorrow, she depended on government benefits, of which would have been lost entirely if they didn't address setting up a special needs trust, which is something we help them accomplish. So you have to think through all these different situations, some that are so easy to overlook. And I think our own experiences are some of the most easy areas of our life to overlook, because they're so well ingrained in our ego, in our identity. Number 4, money experience dimensions and how they impact your personal financial plan.
Yeah, not only your investment strategies, but also, how you interact with your advisor, your aptitude, your interest in managing finances, your prior experiences in managing investments. What did you do in 2008? What did you do during the last downturn? But then understanding your comfort level with market uncertainty, risk, learning styles. This is where things are very dynamic.
Yeah. And this article continues to dive into next specific advice around 529 plans, income strategies, chronic illness, caregiver issues, sole breadwinner issues, life insurance. It covers the gambit and offers some good specific advice. So if you'd like to get a copy of this article, check it out at retirewithpurpose.com. And remember this, it just wraps up with this, right? Does the financial advice you're following reflect the many facets that make up your financial life? Has someone given you the attention you need in order to create a unique financial plan, or are they using a cookie cutter approach? Do you look like every single other one of the clients that they work with? Does your plan look like every single client that they work with? Because it shouldn't. It should be unique to you. You should have a financial plan that's designed uniquely for your unique situation. And if you'd like to get that, give us a call right now. We have a special offer for the next 10 callers to meet with an independent financial advisor on our team. You can do this in person. You can do it through a video meeting from the comfort of your home, and we'll help you determine how prepared you are to handle everything that retirement can throw at you, from stock market crashes to rising taxes to currency devaluation. In short, we'll take the guesswork out of financial planning to you and deliver to you a free, comprehensive financial plan. It can take just 30 minutes. So for the next 10 callers that call or text the word consult, that's consult, to 866-482-9559, 866-482-9559. Right now, we're offering a comprehensive financial review at no cost, 866-482-9559. We'll be right back here with you next week on Retire with Purpose.
You've been listening to Retire with Purpose, hosted by Casey Weade and Marshall Johnson. Investment advisory services offered through Howard Bailey Securities, LLC, a registered investment advisor. Working with Howard Bailey Securities, LLC cannot guarantee investment success or that specific financial goals will be achieved. Certified Financial Planner Board of Standards, Inc. owns the certification marked CFP and Certified Financial Planner in the U.S., which it awards to individuals who successfully complete CFP Board's initial and ongoing certification requirements. Howard Bailey Financial is a registered trademark of Howard Bailey Financial. All rights reserved. Information is not intended to provide specific legal or tax advice. Howard Bailey Financial nor its advisors are qualified to give tax or legal advice. You are encouraged to consult with your tax or legal professional for guidance on your individual situation. This radio show is a paid placement.